Speaking about the markets, there's these two words that have been thrown around like arbitrage and hedge funds. Maybe you could elaborate a bit
Right.
on that?
So arbitrage is of multiple varieties. Typically, if one person invests in, say, India, and then typically removes his investment and moves it to, say, a Japan, what happens is that the arbitrage is basically the movement and the change in the market prices, which typically moves down to the difference of 1 by 10,000. Is it allows for a stable percentage of growth. An arbitrage fund would give you a return of, say, 7 to 11%. And an arbitrage fund usually sees pricing differences, timing differences, and bets on that. It is highly stable. The liquidity, may become an issue. The return is more or less consistent every year. Hedge fund is mostly accessible only to the ultra wealthy. They bet on markets. So they would typically overbuy in a region they feel will have regulation coming in. This is a global macro hedge fund. And of course, the problem here in hedge funds is that once you've given the money to, say, a fund manager, the fund manager has the total right for deployment of that money. So your say with regards to your money would be very minimal as compared to, say, a stock market wherein you can invest directly through a broker. There you typically want to buy a stock and you can guide the broker accordingly.